So this type of practice will be very helpful. How to predict direction is very important question. Let us see how we can do it. We can define direction based on option chain. What are characteristics of bearish option chain? For bearish, first thing is prices will be down. There will be put unwinding. What is meaning of put unwinding? Short positions in puts will be covered. Open interest in put side will be decreasing. And put premiums will be increasing. On call side, what will happen? There will be short built up on call side. There will be increased open interest in call side. It may be in the money, at the money, out of the money calls. In the money are not too deep in the money, slightly at the money or slightly in the money. Option premiums will be decreasing with increase in open interest. That will be short built up in call side. And future open interest, if indicates increase in open interest with fall in price of underlying, then it is also indicative of bearishness. So one can also have a look at future open interest. Around 10 to 20% increase in open interest is significant open interest, and if it is leading to price fall, then that means bearishness is more prominent. How can we define bullishness? Prices will be up in underlying. There will be call unwinding, means open interest in call will be decreasing and prices of call options will be increasing. This is bullish behavior. Then what will happen to puts? There will be short built up on put side. Prices will decrease on put and premiums of put will decrease and increase in open interest will be seen. Change in open interest will be higher on put side. What will happen to futures? Open interest in future will be increasing with price rise. This is very bullish sign. If open interest of futures is increasing and price is increasing, that means people are buying futures and increasing prices. How can we define direction of range bound market or moderate bear, moderate bull market? Usually when markets are range bound, there is no unwinding of call and put side, and open interest increases on both sides. There will be small change in option premiums, but it will not be too much. But open interest will not decrease, and usually future open interest is stable because people usually take directional trades with futures. They do not take non-directional trades with futures. They can buy at support, sell at resistance. So open interest keeps on changing slightly, not too much in futures. So range bound market usually does not show unwinding. It shows increase in open interest on puts as well as call side without much change in option premiums. Now, is it possible to define trend reversal based on option chain? It is possible sometimes when prices of underlying are increasing without unwinding of calls, and when there is increased call writing at higher strikes, bearish reversal is possible. Means people are not exiting their current short positions in calls. There is no unwinding, and they are also shorting calls at higher strikes. So even if market does not go lower, their call premiums which are in loss will be covered by out of the money call writing. This means people are not expecting higher prices and they are not unwinding their calls. So at this time bearish reversal is possible. For this, trend should be up prior to this formation, and then people are not willing to exit their short positions in calls. How can we see bullish reversal? When there is fall in price of underlying and puts are not getting unwinded, but put writing is increasing. That indicates people are willing to write puts. If there is unwinding, that means people are fearful and they are exiting their short built up. So when short built up in put is maintained and people are not unwinding their short built up, or there is no short covering in puts, then bullish reversal is possible. So is this clear? Any doubts about this? So in this example, we can see that premiums are decreasing on put side, option open interest is increasing on put side, premiums are, that means short built up is getting created here, here long built up is getting created, and both are bullish. This type of option chain analysis can be very useful for intraday option trading by determining support and resistance level and taking appropriate positions near support or resistance. When view is bullish, we should take bullish position at support or after the resistance is broken. When view is bearish, we should take position near resistance level or after break of support. This helps in keeping position in loss for shorter time. Drawdown is lesser and time for drawdown is shorter. If our view gets wrong, our loss is limited. For example, suppose 37,000 is support, 37,500 is resistance, and we are expecting move from 37,000 to 37,500 for intraday trade, or maybe 37,100 to 37,300. If view is bullish, we should not take bearish position at 37,500 or 37,300. When we expect that prices are going to increase, we should try to take position at or near support. When support is 37,000 and underlying is trading at 37,300 or 37,250, we should not take a bullish position. We should wait for prices to come closer to 37,000 or 37,100 so that we can initiate a bullish trade and we can expect larger profits with smaller drawdowns possible. Now let us see what are different types of trading days. Most of the times, around 70%, we can say markets remain sideways. 30% of the times markets are trending. Trending days can be of two types. One is directional trading day, where markets open, gap up and continue upside, or open, gap down and continue more down movement. There is another way of trading day, which is reversal day. Initially markets show one direction and they trap the traders, then direction reverses and trend changes. On non-trending day, we can see options writing on both sides. There may be mild bullish or mild bearish picture. When directional moves come, then there is long build up in option positions and probably not so much activity on other side. When directional moves come, then there is long build up. So if there is bullish directional move, then there will be long build up in call side and short built up on put side. Whereas for bearish directional view, there will be long built up in put side and maybe short built up on call side. But in reversal moves, usually unwinding happens. In directional moves, there is build up. In reversal moves, usually unwinding happens. These are not the rules, they are general observations. We can accomplish rules only after checking option chain for maybe few hundred days. We can work together on this aspect and make our rules for our benefit. We have to check intraday chart of option snapshot, whether it indicated short built up on both sides, long built up on one side and unwinding on other side. Long built up on both sides is not possible, or unwinding on both sides is not possible. It is preferable to have directional strategy instead of having non-directional strategy or neutral strategy. Why is it so? Because if our view is bullish and we take bullish position, what will happen? If day is bullish, we get profit. If day is neutral, we may get profit. If day goes bearish, we will lose. So there are 2 chances out of 3 probabilities, 2 are in our favor. Similar is for bearishness. When we take bearish view and if there is reversal, what will happen? We will lose. But if trend continues to be bearish, then we make profit. If day remains neutral, then also we make profit. So having directional view gives us 66% chances of winning. But if our view is neutral, we will get good profit when day is neutral. But what will happen if there is bullish move or bearish move? We will make loss. So there is only 33% chance of making profits when view is neutral, whereas there is 66% chance when view is directional. So it is better to have directional view for option trading.